Okay, hello everyone, and welcome to this webinar brought to you by fxstreet.com. My name is James Chen. I'm the Chief Technical Strategist here at FX Solutions, and we are in the U.S. Okay, so let's get started real quick. I'm just trying to get used to this new WebEx recording, webinar system, and hopefully we don't have any hiccups here. So let's get started real quick. Today is my monthly webinar on FX Street. Now, before we get started, as always, just a quick important notice. Forex trading involves a substantial risk of loss and is not suitable for all investors. This information is being provided only for general market commentary and does not constitute investment or trading advice. These materials are not intended as an offer or solicitation with respect to the purchase or sale or any financial instrument and should not be used as a basis for any investment decision. Past performance is not necessarily indicative of future results. And, of course, do not invest money that you cannot afford to lose. I'm going to leave that up just for a few seconds and then we'll get started. Okay, today's topic. I'm going to be talking about a topic that I talk about quite often. Because it's a very important topic, and it is combining candlesticks with Western technical analysis. Now, as all of you may know, candlesticks were brought over from Japan a long time ago, where we've sort of incorporated it into the technical analysis that we all use now, and they are very important in confirming or warning of potential technical events in the markets. And today I'm going to be showing you a lot of examples on the charts of where you could combine the candlesticks with your other elements of technical analysis and where it makes the rationale for getting into or out of a trade much stronger and it could help your trading. So let's talk about that today. And let's get started real quick. What I'm going to do is I'm going to provide you with just a little bit of background information on how you might be able to combine candlesticks with other elements of technical analysis, and then I'm going to go through some comprehensive chart examples on different currency pairs where you could see exactly how this may play out for you. Now, in terms of, just to simplify this subject a little bit, essentially what we're talking about is taking different, very simple candlestick patterns and then combining them with essentially what it is support and resistance. So if you combine simple candlestick patterns with support and resistance, they can make for a very strong potential strategy for using to trade directionally in the currency markets. And I'll show you exactly how it plays out on my charts. I have a bunch of examples for you, so we'll get to that. If you have any questions, please feel free to type them into the chat window, and I'd be more than happy to answer them. So let's get started. Okay, just a quick overview. I know a lot of you may know what candlesticks are, but those of you who are not aware of what they are or how you could use them, just a very quick overview. Japanese candlestick analysis was brought to the West by a trader and analyst. His name is Steve Nissen, who's very, very active still in the markets and in teaching and in trading and analyzing the markets. And basically what he did was he took some Japanese manuals on candlesticks and he adapted them into English and sort of introduced it over to the West. Now candles work for all financial markets, and they have been applied to all financial markets, but they're slightly different for the Forex market because of such characteristics like we have a 24-hour market and a relative lack of gaps. You see a lot of different candlestick patterns that talk about gaps. I'm not going to be talking about those because they play less of a role in the Forex market because it's a 24-hour market. And we have a relative lack of gaps. So I'm going to be talking about more of the simple, the very, very simple patterns that I'll show you in a minute. Now, there is a subset of candlestick patterns that Forex traders focus on, and these will be covered in this webinar. Many candlestick proponents, including Steve Nissen himself, I've done a lot of work with Steve Nissen in the past, and I've got to know exactly how he approaches trading with the candlesticks, and basically He also adds, and many candlestick proponents advocate, using candles to confirm or be confirmed by Western technical analysis, by other technical analysis methods. Not only that, you could also combine it with other, fundamental aspects of trading, fundamental analysis. So this cannot be stressed enough that we really want to be using candlesticks not as a primary trading tool, but more of as a way to supplement or complement your other trading tools. Now, what do candlesticks excel at doing? Well, they excel at confirming or warning of potential reversals in the market. Okay, and they're ideally used in conjunction with Western technical analysis. This is what we call confluence. Okay, so oftentimes when you see, let's say, a support resistance level, you see price approach that support and resistance level. Now, when it approaches there, you'll also see oftentimes a candlestick pattern. Now, that is what we call confluence. Confluence is just a coming together of different aspects of your technical analysis that support a trade, that makes the opportunity for that trade stronger, the rationale for that trade stronger. And that's really what we're looking at here when using candlestick patterns. So now, when we talk about candles confirming or warning potential reversals, let's say you're a trend trader. How could you possibly use that? If you're not looking for really reversals in the market, more you're looking for to play with the trend, to trade with the trend. Well, simply, there are many reversal patterns that reverse pullbacks or reverse retracements or reverse corrections within a trend, and you could use those as well. And actually, I'm a big proponent of doing that, of taking these candlestick patterns and looking for reversals within trends, reversals that take price back in the direction of the trend. And I'll show you examples of that on my charts in a minute. Now, we utilize candles instead of bars because really, if you take a look at bars, and I'll show you a bar in a second, but a bar chart, but if you take a look at candles versus bars, there really is no disadvantage in terms of using candles, and they're the only advantage. It essentially has the same price information, the open, high, low, and the close. So we really don't have any difference there in terms of the actual price information that is provided. Now, the candlesticks, what is the advantage of them? The advantage is that they provide a more visual representation of the sort of conflict between the bulls and the bears, and I'll show you exactly what I mean in a second. Now, this combination of candlesticks and Western technical analysis can be used on all time frames. I'm going to be showing you on a little bit longer time frame than you may be used to. I'm going to be looking at mostly daily charts, also 4-hour charts, but mostly daily charts. And this may be a little bit longer term than you're used to, but we'll show how these candlesticks can be used very, very effectively on these on these higher time frames. Now, the elements of Western technical analysis that I use, they all center, as I mentioned, on support and resistance. Okay, when you take a look at it, all of the main, or most of the main elements of technical analysis that I use center upon support and resistance. So we talk about horizontal support and resistance lines. We talk about trend lines, which are also support and resistance. We talk about chart patterns, like the triangles, the rectangles, the flags and pennants. Those are all also, all about support and resistance. We talk about Fibonacci's, okay, also support and resistance. Pivot points, support and resistance. Bollinger Bands can be used also as support and resistance. Moving averages as well. Also, it all comes back to the central idea of support and resistance, and that's essentially what I'm going to be talking about today. Oscillators, not so much, but still, when it comes down to it, the main tools that I use come down to looking for support and resistance, looking for potential bounces, potential breaks of support and resistance, and these, for all of this, candlesticks can help, very much so. So they are used as a very strong potential confluence tool to show me, is there going to be a bounce at this level? Is there going to be a breakout at this level? And I'll show you exactly how that works in a minute. Now, the key point here, one of the key points here, is that long shadows, or you can call them wicks, whatever you want to call them. There are those little. I'll show you on the diagram in a second. But the long shadows or wicks are, essentially represent potential price rejection and failure, okay, and a potential turn in the market. So they forewarn of possible turns, and that's one of the main ways that we use candlesticks in conjunction with support and resistance. Okay, so let's move forward real quick. Yes, this is the basic structure of candle versus bar. I'm not going to go through this much because you probably all know what this is, but this is a simple OHLC, or open, high, low, closed bar. As we can see here, it opens on the left, closes on the right. Okay, and then we have the low near the low at the bottom, and the high at the top. So we have the open, high, low, and close. Now the candlestick has exactly the same information. Okay, the open is either the bottom of the body or the top of the body. The close is the other side, is either the top of the body or the bottom of the body. The high is the very top of the wick, and the low is the very low of the wick. Okay, and this is for each period that we're looking at. So, for example, if this is a daily candlestick, we're looking for the open, high, low, close on a daily price action. Now, if we take a look at this candlestick, very simply, for those of you who are not familiar with this, we have it's based on colors. So usually you have either white or black. Okay, white or black, or green or red. Green and red. Okay, so if you have the white and black color scheme, then what we're talking about is a white candle, a white body is a net bullish body. That means it opened on the bottom and it closed on the top, and that gives you a visual representation that that was a net bullish candle. Okay. By the same token, a black body would mean that it opened on the top and closed on the bottom. That's a net bearish candle. Now, if your charting platform has a different color scheme, and this is the one mine has, it's green and red. So that means if it's green, it's a net bullish candle, which means it started down here, it opened down here, and it closed up here. That's a net bullish candle. If it's red, that means it's a net bearish candle. It started up here at the top of the body, and it closed at the bottom of the body down here. Okay, so just a quick refresher for those of you who are not familiar with what candlesticks are. Okay, so how does it give you a good visual representation? Well, essentially, what it shows you by colors, it shows you we have a net bullish day or we have a net bearish day. If it's a net bullish day, that means the bulls essentially won out over the bears. If it's a net bearish day, that means the bears won out over the bulls on a net basis for that particular period. Okay, so enough of that. Let's go forward here. Okay, these are the common Forex candlestick patterns. Like I mentioned before, they're all very, very simple. Okay, sort of by in the order of importance for me at least. These are the candlestick patterns that I look at, and I'll show you visual representation in a second, and then I'll go to my charts and show you exactly what I mean. Okay, so we have the hammer and the shooting star. Those are very, very important to me. Okay, and especially if those occur at support and resistance levels, and I'll show you in a second. Now, we also have hanging men and inverted hammers. We have doji, which are also very important. They talk about potential indecision in the market. We have spinning tops, which are sort of similar to doji. We also have multiple candlestick patterns, including the bullish and bearish engulfing patterns, harami, and there are many, many others, but these are basically the ones that I'm looking at on a daily basis in order to combine with the other elements of technical analysis to provide me with potentially high probability opportunities to enter and or exit any given trade. Okay. These are the visual representation of single candle patterns. Okay, now, of all of these here, the most important ones, as I mentioned, are the hammer and the shooting star. Why? Well, I'll show you. It just makes a lot of sense, and it really, really, tends to work when you combine it with the other elements of technical analysis. So if you take a look here at the hammer, what is this? It's simply a downtrend. Okay, we have a downtrend. We have these net bearish candles. Okay, a move to the downside. This candle here, which is called the hammer, is simply it started up here on the very top of the candle. Okay, it opened there, and then it closed just below that. So that has a very small body. Okay, but in the middle of this, in the meantime, what it did is it went all the way down to a low, and then came all the way back up. What does that mean? That represents price rejection, price failure. If this occurs at or near a support level, that for me is a very strong potential signal that perhaps we're having price rejection and a move back to the upside. This downtrend is not able, or it doesn't have the strength. The bears don't have the strength to continue this downtrend, and we're getting rejected and moving back to the upside, and the downside momentum is losing out. Okay, and then you have a potential for a turn to the upside. Same thing with the shooting star, but in different. The different. We have an uptrend on the shooting star, and then we have a candle where it opens at the bottom and then goes all the way up and comes back down and closes near the bottom. So we have a very small body and a long upper shadow, a long upper wick, and that shows rejection near the highs. This momentum is losing out. This upside momentum is losing out, comes back down. There's rejection, there's price failure, and if it occurs around a resistance level, a very strong potential indication that perhaps there's loss of upside momentum and perhaps there might be a reversal to the downside. Okay, so hammers and shooting stars, I don't care what you call them. Just look at it visually. You don't have to worry about the names of these, but look at it visually. That's what I mean. Okay, and then over here on the very left-hand side, the doji. It simply means that price action for that particular period opened at a certain price. It went up, it went down, it went down, it went up. We don't know which first or last, but it went up and down, and then it closes the period right at or very near where it opened, and that shows potential indecision in the market. Okay, so that's what's called the doji. There are many different types of doji out there, but essentially they have the same principle: open and close at or very, very near the same price level. And in between move up, move down, it represents indecision. Same with spinning top, or very similar with the spinning top. We have a small body here. We have a long upper wick, long lower wick. That talks about also potential indecision. We have moves to the upside, we have moves to the downside, we have conflicts between the bulls and the bears, and finally end up right around near where we open the period. That is potential indecision as well. Okay, these two are not as important for me because they don't have as strong of a visual representation as the others, but here we have the hanging man, which is simply a small, for an uptrend, we have a small upper body, a long lower wick, also potential indecision in the market, potential turn to the downside there. Inverted hammer, we have a downtrend here. We have a candle with a small lower body, long upper wick, also potential indecision in the market there. These, again, the hanging man and the inverted hammer, not nearly as strong for me in terms of the signal they produce or the indication they produce than, as the hammer, the shooting star, and the doji as well. Okay, so hopefully you got that. Okay, those are the single candle patterns I use. Again, very, very simple stuff. Okay, now we take a look at multiple candle patterns. There are a ton of candlestick patterns. If you take a look at Steve Nissen's book, I believe it's called Japanese Candlestick Patterns or something like that. It's very straightforward. There are many, many different candlesticks patterns there. I've studied all that. I look at all that. I've used all of those, but at the same time, I like to simplify things and look at only those potential indications that work the best for me, that I find on a regular basis help me out in terms of providing support or confluence for potential trading opportunities. Okay, so we have multiple candlestick patterns here. The ones I use, again, there are many of them, but the ones I use here are the bullish engulfing pattern, the bearish engulfing pattern, and to a lesser extent, the harami. Okay, so we have the bullish engulfing pattern. Simply what it is a small body here. We're just looking at bodies here. We're not looking at the wicks here. We have a small body here, and then the next candle is a large bullish candle which engulfs or encompasses the prior bearish body. Okay, so what is it telling you here? It's very, very straightforward. We see a small body here, which in itself represents indecision. So we have a small bearish body here. Okay, so there's a little bit of indecision in the market, and then right after we see the bulls very, very clearly winning over the bears. Okay, so we got a big move to the upside that encompasses the prior candle. This is talking about there must be something going on in the market where the strength to the upside far exceeds the strength to the downside on the prior candle. Okay, same thing with the bearish engulfing pattern, just to the opposite side. So we have a small bullish candle here, okay, which in itself represents some indecision in the market, and then we have a large bearish candle that talks about, the bears winning out. So the bears are coming in force here. They're stronger than the prior, bullish candle, and therefore we have a bearish engulfing pattern, which is a possible turn to the downside. Just like the bullish engulfing pattern is a possible turn to the upside. Okay. Not only can engulfing patterns be used for potential reversals, but also potential continuations. Let's say you have an uptrend, and then in that uptrend you have a flag pattern. Okay, in that flag pattern you have a little bearish candle. Right after that candle, we have a larger engulfing bullish candle that breaks out of the flag to the upside. Okay, so that's another way that we could talk about a continuation pattern using these multiple candle patterns. So we're talking about engulfing patterns showing some side winning, whether it's the bulls or the bears. Okay, a lesser extent because it doesn't make as much sense to me as the engulfing patterns, but the Harami is basically the opposite of engulfing patterns. We have, we have a big move. Okay, in this case, on the left-hand side, we have a big move to the upside. This is a bullish candle, and then following that, we have a smaller bearish candle, which shows in itself indecision in the market and a possible turn. Okay, a possible reversal, possible turn. Same thing to the right-hand side. We have a big bearish candle, moves to the downside, and then after that, we have a small candle after that, and that shows indecision, a possible turn. Okay, again, not as strong for me as engulfing patterns or as those other single candle patterns I showed you before. These candlestick patterns, but they are patterns nonetheless. Okay, so those are the ones that I really focus upon when I'm combining them with regular technical, Western technical analysis. Okay. What are the Western technical factors that I use? Well, as I mentioned, they are all pretty much focused on support and resistance. So, most importantly, we're looking at previously visited horizontal support and resistance levels. Okay, so where price previously turned in the past. So, if we take a look at, let's say, the 160 level on the pound dollar. Okay, that is a very strong support resistance level because of many factors. Because price turned a lot at those levels, because also it's a psychological round number, 160, and it's just a key support and resistance level. Also, we have trend lines. Okay, trend lines are also support and resistance, but they're diagonal, they're dynamic support and resistance, but they're support and resistance nonetheless. And I'll show you that in my charts in a minute. Fibonacci levels, whatever a lot of people are trade primarily on Fibonacci levels, which is fine. But what do they essentially represent? Support and resistance. Same with pivot points. You talk about Western reversal patterns, it's also all about support and resistance. Tops and bottoms, head and shoulders, etc. Bollinger Bands, oscillators as well. Okay, let's move on. Okay, now before I go to the charts, just a very quick thing about Confluence, and I know a lot of you may have heard this before, but just, this is how important it is. It sounds very simple to combine candlesticks with support and resistance, but it can be used very, very effectively, just those two elements. Now, what does this represent? Again, it represents Confluence. It's about different technical confirmations coming together to support a trade. As I mentioned before, let's say you have an uptrend. You have a flag on that uptrend, which is a slight pullback move, okay? And then you have a bullish engulfing pattern that breaks out of that flag. That's telling you not only do I have an uptrend, not only do I have a continuation consolidation pattern in the flag, but I also have a bullish engulfing pattern that's breaking out of that flag. So perhaps, this market is looking to the upside, okay? So you have stronger confirmations. And a lot of people ask me, then do you get paralyzed by analysis? Well, I'm not telling you to take every single, star in the universe and have it line up before you look to get into any opportunities. I'm saying, use some, at least two confirmations that perhaps you've got the right direction, number one, and perhaps you've got a good entry level and or exit level. Okay. So coinciding technical factors, like I just mentioned, they collectively reinforce each other, and these make for better potential trading opportunities. And it can be any combination of two. In this case, I'm using candlestick patterns and support resistance. Okay. All right. So let's get started real quick. Let's go to the charts. And these are charts courtesy of FX Solutions FX Active charts. For those of you who are not familiar with me, I was away. I was away from FX Solutions for about a year, a little over a year. Prior to that, I was at FX Solutions for about 5 to 6 years, and now I'm back at FX Solutions, and I'm glad to be using the AccuCharts again because they're really, really good, and they're really powerful. So let me show you them real quick right now. Hopefully you can see this. Okay, I've taken the liberty of marking up the charts just to give you some okay, so just hopefully if you cannot see it, please let me know. Okay, these are my regular analysis. It looks all marked up. It's ridiculous. There's so many lines here. But this is, essentially what I have on my charts when I'm doing analysis. Okay. Now I don't have all these. Notations here usually. This is just for this webinar. I'll show you from the beginning. Okay, from the left-hand side here, let's go back. This is a daily chart of euro-dollar. I have a bunch of different charts to show you, but this is a daily chart of euro-dollar. Right here, we see right around where the highs occurred, we see a doji succession here. Okay, we take a look here, all the way on the left-hand side here, and hopefully you can see that. We see, first of all, see price moves up. Okay, we have this first little shooting star. Okay, right here. If you could see that, let me make this a little bit bigger. Okay, you have the first little shooting star. That's not much because we don't have really established resistance yet. But then we see after a move to the upside, we see a doji, and then we see another doji, and then we see another doji. Okay, that is potential indecision in the market. Now, would I get into a short trade right there just because I see those those right there? No, not necessarily. I'm going to be looking for other potential signals to get into traps. It would be a breakdown of this trend, okay, or something, or a breakdown of some type of support level, okay. So that's why I'm saying that just the fact that you see candlestick patterns does not mean you should necessarily get into any particular trades. Okay. So we see it moves to the doji succession, and it moves to the downside pretty nicely there. Okay, and then what we have here, and I'm just going to go through these different examples here. We have resistance here at about 145.50, and then we have this very nice little doji right here, doji at resistance. Okay, it moves to the downside. We have support right here, around here at 138.50. Okay, on euro dollar. This is a really nice. What is this? Boykin, you need glasses to look at this. Yeah, I know. It looks ridiculous. Mostly because of all these notations that I put up here. But hopefully you can see it. Okay, so we got a hammer as support here. This is a very nice hammer, long downside wick. So what was I talking about here? This move to the downside, a wick. Okay, I'll move to the downside, a wick to the downside, and then chart, but not the candles. Okay, let me zoom in a little bit more. I didn't see that, Jeremy. Let me zoom in a little bit more. Okay, hopefully you can see that. Okay, we have this. Okay, not only do we have this support level here, right around what's this 138.50. But we have a long wick, this hammer at support. Now, right support level is also this. This is the 200 period moving average, 200-day moving average. Okay, so that's a potential for a turn up. Okay, so that's a pretty good see support. First of all, you see support. Second of all, you see this is the 200 period moving average right here, which can also act as support. Okay, and then we also have this nice little hammer candle here. Rahul, any idea how to read action before low participation candles, where the trend will suddenly break? Yeah, I'll show you some examples. I think I understand what you're saying, but I'll show you examples of that in a second. Okay, so we have a strong hammer support. Okay, right up here we have a spinning top right here. Again, see we have doji at resistance right here, right around the 145.50 area. Okay, and then we have a little spinning top here as well. You know, does that mean it's going to turn there? No, absolutely not. But it's another key here that we have strong support here at 145.50, and then we got a spinning top, and perhaps that could be a move bottom. But not only is this a spinning top at resistance, this is also what we call a bearish engulfing pattern. Okay, so it's a spinning top and a bearish engulfing pattern, a move to the downside, a possibility for a break to the downside. Now, what is the trigger to get into this trade? Is it right here at the spinning top or right under the spinning top? It could be. If you're not aggressive, then it could be some other trigger. It could be perhaps this. This was sort of a triangle here. If we look here, this was a triangle. We had resistance here. We had support down here. Possibility for a move to the downside after we had that resistance with the spinning top. Engulfing pattern. It continued to the downside, and then we have this support line here on this triangle. If you could envision that, okay? And then a break to the downside, okay? And then we have a succession of long wicks to the downside. Now, if you take a look at this, okay, so we have a move to the downside, okay? And right here, we have support, okay? We have support right here at this upper support line. It's a confluence support. Why? We also have the 200-day moving average right here, okay? Now, there's a move to the downside. We have a candlestick here where it tries to retrace, it's unable to do it. Okay, it's unable to move up. So a long wick here represents rejection, represents failure, and right around near resistance here at around 142.50, like I showed you before. Okay, so move to the upside, and then we have a break to the downside from there. So that's just one clue that you could potentially use. Okay, over here, hammer at support. This is not the best hammer in the world because, you have a rather large, body here, but still, we got a nice long wick here, right at support at what level? 135. 135 is a key level on Eurodollar. Okay, so we'll pop to the upside. Not a great move. This was just a pullback move within this downtrend. It was a pullback move, but it was a signal of a turn nonetheless. Okay, we have double test support right around here, 130, 170. If you take a look, 130, okay, 130, 170 here. That sort of establishes the 170 level as a potential support level right there, okay? Okay, so here we have, up here we have a Harami resistance. What is this resistance? This resistance is around the 50 area, okay? We have a long candle. This is an uptrend here, and then we have a Harami right here, and then from there we have a move to the downside. Is that the trigger? No, that's a confirmation of a potential turn to the downside off of this resistance level right here. Okay, can you make that big chart? Is that bigger? Is that better? Hopefully that's a little better. Okay. All right, so we have that Harami at resistance, and then we have a move to the downside. Okay. Look here. Okay. A move to the downside. It breaks below 138.50. Support, and then we have several different systems here, one of which is a bearish engulfing pattern right here, right at resistance. Key resistance here at 138.50, and then a bearish engulfing, possibility for further downside there, and then, so to the downside, it comes back up, it pulls back up, to the 135 level, and here we have spin up at resistance. Just another sign that perhaps there might be, a turn to the downside again, or a continuation to the downside. Okay, let me just make this a little. Okay, so what I was talking about here was, where we could talk about potential continuations of the trend using these, so-called reversal candlestick patterns. So if we take a look right here, we have the shooting star resistance. Okay, again, 3170. Okay, you take a look here, back here, daily, the double support right here at 3170. Okay, so 3170 becomes the key level. Which it still is, by the way. So this was back in 2001. I'll just show you the past here. But so we have a test that breaks down below the loop, and then there's a retest there. This is a shooting star. Okay, this is a shooting star. It's sort of an up move, a shooting star candle, and then a continuation to the downside. Okay. Okay. So moving forward real quick. We have a hammered support here. We have bearish engulfing at resistance. So, if you just use key support and resistance levels, whether it be from the horizontal support and resistance, the Fibonacci levels, the trend lines, the moving averages, etc., and you combine them with potential patterns, candlestick patterns, then it can be very, very powerful. Okay, on the Harami, okay, one second. Boyke, do you use diagonal trend lines for support and resistance? Absolutely. And that's what I was just talking about before. Absolutely I do. So, for me, trend lines are, in terms of support and resistance, are not as strong as key horizontal support and resistance levels, but they're also one of the primary ways that I measure support and resistance. So if you take a look here, I have all these green lines here. These are simply, trend lines. So we have a long-term downtrend here, but we have counter trend moves. Okay, we have counter trend moves. So these counter trend moves, you could draw trend lines, as you can see here. So we have a trend line right here, break to the downside for a short move to continue the long-term down. Same over here. We have a move back in line, a move back up to the long-term downtrend line, and then we have a break to the downside. Okay, and that break is a break of support. That's all it is. It's just a break of support. Carlos, on the Harami, the bearish or bullish candle, the body has to be inside the previous bar, right? Yes, it should be inside the previous bar. Yes. Okay. Let's take a look here. Okay, so we have hammer and hammer. Okay, this is one. Let me just qualify this real quick to say that if you're trading on a 1-minute chart, perhaps as I said before, the candlestick patterns work on all time frames. But realistically, if you're trading on a 1-minute chart, the noise there, from my perspective, is just too much. And if you have a nice candlestick pattern on a 1-minute chart, for me, not nearly as strong as if you found a good candlestick pattern on a daily chart. Okay. So if you guys know me, if any of you know what I've talked about before, I don't really look at really short-term charts. Okay. Only when you get to the somewhat higher term, the longer term charts, will you be able to see that candlestick patterns work much better than on the very short-term charts. Okay. So just an aside there, a note there. Okay, so let's move forward real quick. Okay, some interesting stuff. We have this spinning top Harami right here at resistance. Okay? Spinning top, so a little bit like a doji, but not exactly surprised. It's also Harami right near, as I mentioned before, 131.70, which was key resistance in the day. Okay, it's not really a round number, but it was pretty strong resistance back over there. Now we get to the more current charts here, and then here, as I showed, as I did in my analysis, if you ever look at my analysis, which you can find on fxsolutions.com, you see here that we have a pullback move. Okay. Okay, so we have a pullback move here, as you can see. Okay, now this pullback came back to 128 support. I was actually on Bloomberg TV in London last week, and I talked about this as well. We had this pullback move from the 131 high distance, okay? We have a pullback move that goes back to this confluence of support. So talk about confluence. This is a really good confluence here. So we have a pullback move that goes back to 128. Not only is it 128, it's also this 200-day moving average, okay? And then it goes back again to the same level, 128, same approximate level, 128, which is again still at the 200-day moving average, but it's also this uptrend line right here. So we had a strong confluence of support there. We had a bounce to the upside. We could see some good candles here as well. And then went up, just in 130, 170, it pulled back, and now what do we have here? We have a candle here that came back right back to the trend line. Okay. All right, let me move forward real quick. I think I'm running out of time here. Now, this is a 4-hour chart. Okay? This is a 4-hour chart of euro dollar, just to show you on another time frame. Okay, we got a test of resistance here. Once again, the 131.70 area right here, okay? And then here on the 4-hour chart, if you drill down to the 4-hour chart, from the daily chart, you can see that we have a nice candle up here. We have a nice wick to the upside. So that was rejected. It was a double test of 131.70 the next day. 131.70. Double test, and then with this candle here, and then it moved to the downside. So that's a potential move right there. That could be advantage. And then here, see right below 130, also a key level on euro dollar. It's a key, round number and all that. So over here, we see, it breaks to the downside, comes back up, but it's unable to go back up above 130, right? It does go back up, but it's unable to close above there. We have these candles. We two nice candles here. These are sort of what do you call it? The shooting star candles. So we see projection right around resistance here. Okay, so support here. Okay, it tested support here. It broke to the downside, and then we have price trying to move up there. And then moves to the downside, and then we here it moves to 128. And here it just comes short of 8. We have here at this confluence of support. What is this? It is a nice little hammer candle right there. Okay? And then a doji right after that. Okay. Let's move forward real quick. I have a bunch of other. Okay. Jeremy, can you tell us how you apply the candles to confirm confluence? How many items do you use as a minimum? Okay, good question. Doji plus SR level plus any others. Okay, great. Great question there, Jeremy. I'm always looking for confluence. Okay, so what is the minimum? Very good question there. Now, as I mentioned before, many people, including myself in the past, have often used just two elements to trade. One is support and resistance, and the second is candlesticks. Okay, so if you have a strong enough signal there, then that for me would be a minimum. Okay, now is this to say if I also have let's say an oscillator that's telling me the same thing, or a moving average that's telling me also the same thing, also the same direction, would I ignore those? Absolutely not. I'm looking for as much confluence as I can. But if I have a strong enough signal using only, let's say, a support and resistance level and a candlestick confirmation, then oftentimes I will look to get into opportunities like that. Okay, so great question there. Okay, so this is the what do you call it? The pound dollar. We have here 163. Very key level. Okay, my charts don't go back that far, 4 hour, but I have 163, key level right here, okay? And then you come over here, and this was in September of this year, and we see what we see here, key rejection. Okay, you could call this I call it a head and shoulders pattern, but there are a bunch of shoulders here. So I don't know if you could really call it that. So one head, we have a very nice shooting star candle right here. Okay, so very nice shooting star candle right there. What are the blue squares? These are Fibonacci levels, Boyke. These are Fibonacci levels. This particular one, I had I was using this was back then. I was using this one right here and projecting potential extension, Fibonacci extension levels. So I had here, it was, drew this, you had the 161% over at around 160. And then you had the 261.8% over around 161.50. So I use those as potential targets. Use those as potential targets. Hopefully you can hear me. Okay. So have this here. We have this here at chart 1. Same thing on the daily chart. You take a look at the daily chart, but I think I've run out of time anyway. But if you take a look here at the pound dollar, we have 163 on the daily chart. We also have this huge shooting star resistance. Very, very nice there. Okay. And then here we have a bearish engulfing axis for the sound completely cut on. Okay, same thing here. This is the Aussie dollar. Okay, hopefully you can hear me. We have 106, and here this is called Doji Shooting Star. So we have a Doji and Shooting Star in the same candle, right around this. Nice occurs right around this. So what I'm saying is that combining candlestick patterns much like these, especially on the longer term charts, with support and resistance, with elements of technical analysis, of Western technical analysis, can make for potentially higher probability trades. And I think I've run out of time here, and I want to thank all of you for coming today. If you have any questions, I can be reached at, and let me just write this down real quick, fxsoul.com. That is my email address. Please feel free to email me, and I want to thank all of you for your time today. Thank you very much.